Hello everyone again. Today is Sunday, May 17th. I have my Google Finance analysis spreadsheet pulled up, and what I wanted to talk about today was the top three semiconductor stocks that I've been looking at, doing some due diligence and some analysis with the tools that I have. And I think with the up and coming event of 5G phones, and we're just at the beginning of that, but I think there are three companies in particular that stand to benefit a lot from that technology. So we'll get into it right here. So the three that I've kind of designated are Micron, um, which is ticker MU, Marvell, ticker MRVL, and Qualcomm, ticker QCOM. So we'll go ahead and we'll take a look at MU. Okay. Go to this one. All right, so right now, share price $44 a share. It is under the 50-day and the 200-day moving average. What I find interesting about this is that it's got a price to earnings ratio of 21, which for a semiconductor stock is actually pretty low. We've got 28% growth in the last year, 68% growth in the last 5 years. It has outperformed the S&P 500 over the last 5 years, and my magical tripwire, if you want to call it, is going off, which means it satisfies a price to earnings growth ratio below 1, growth rate in the last year above 20%, price to earnings ratio between 20 and 30, I think, and below the 50 and 200-day moving average. And like I said in one of my previous videos, this trigger does not stay lit very long, and I honestly just wanted to give you some evidence that it does in fact work and it does go off. It doesn't just say false or NA all the time on these. But so I'm excited that it went off again. Like I said before, it went off on Qualcomm and Disney, and actually we'll be taking a look at Qualcomm after this. But if we want to go over to the charts on Micron, we'll pull that up. This is in symbolic. I've used it in my other videos as well. So as you can see, it is down from its upper limit before the coronavirus of about 60. It's currently hit some resistance at a price of about $50 a share, and right now we're seeing it at 44. But the 20-day moving average is above the 50-day moving average, which means we're kind of we could be seeing this one continue to move up as we start to move further into 5G technology. And Micron is definitely a company that's going to be involved with that. But this one has not been below both the 50-day and 200-day moving average, and showed the growth rates and showed the right price to earnings ratio. So I think this stock market correction has kind of brought some of these overinflated semiconductor companies back to a point where we can feel comfortable buying them. And next up, we'll take a look at Marvell. Okay, so what I like about Marvell, now the tripwire for this one is not lit up like it is for Micron. But if we come and take a look at the price to earnings ratio for this one, yeah, okay, we're on the right row now. 11.24, which is insanely low for semiconductor stocks. I mean, usually you've got almost a 9% return on or earnings yield. Outperformed the S&P 500, 86% in the last 5 years, 21% in the last year, and it is just above its 200-day and 50-day moving average. But if we go over to the chart, get a little more analysis on this one. And as you can see, Marvell has not really been that affected by this market. It was at, a high of $28.86 before the virus, and now it hit some resistance at about $28 a share, and right now it's at 26. So, and just a caveat, I think the whole market is going to be trading a little sideways for a bit. But like I said before, I think, and honestly, the best place to buy this would have been when it was down near 17, $18 a share. But obviously, no one was looking to buy at that time during a huge sell-off. Usually people aren't thinking that direction. But I think what we're seeing here is some good support around the $25 range. And then the 50-day moving average is trending upwards. So that's always a good thing. Even though it is just a little bit above that, and it's a little bit above its 200-day moving average. But like I said, the low price to earnings ratio, I mean, I think, like I said, I think this economic situation has brought some of these technology stocks to a realistic level where we can feel like we're getting value for our money. And we'll check out Qualcomm. Okay, so Qualcomm, I have been trading this myself actually. I bought in at around 73. I think I sold at around $80 a share recently. But, and then I just thought it was too high. I thought it had crossed over both the 200-day and the 50-day moving average. And I think in this particular situation, that was a little high. But the price to earnings ratio is at 22.49. So not too high, but still higher than Marvell down there at 11. But what you get with Qualcomm is that they are very invested in just wireless technology as a whole, and they stand to benefit from 5G as well. And you're not going to be able to pick the stock that is the next Apple, Google, Amazon. But if you know, spread out your capital to 3, 5, 7, however many stocks in a sector like semiconductors, you increase your chances. I mean, and like I was saying, you got AMD over here, which has had huge growth, but the price to earnings ratio is also incredibly overbought. I mean, just that's like a bubble waiting to happen. If they continue to not meet their earnings per share quarter to quarter, they stand for some serious downside potential, which is never really good. So those are the three stocks again: Micron, Marvell, and Qualcomm that I think are some solid picks for the 5G technology that's coming around the corner. Thank you for listening. I am giving this spreadsheet out for free. Just send me an email at mantleenterprises2015@gmail.com. Give us a follow on Instagram at StockLogic. And feel free to subscribe to this channel if you like our content. And again, I'm not a financial advisor. This isn't financial advice. Make sure you do your own due diligence. And I hope I can help you make some money in the market. Thank you very much.